Awesome. We're going to go over the tax control triangle today. So we're going to start out by talking about diversification. A lot of people diversify their assets from an investment standpoint, which means diversification means what? Not putting all your eggs in one basket, right? But a lot of people don't diversify from a tax standpoint. So today we're going to talk about how to diversify from a tax standpoint. And we call it the tax control triangle. Now, when you invest, you can invest into all kind of different investments. One of the first ways you can invest money, guys, is you can invest your money into something that will be considered what's called pre-tax, okay? So you can put money into pre-tax investments. And when they go into these investments, while they're in there, they grow what's called tax deferred. And then when you pull the money out, it'll become taxable, okay? And when these investments and you pull the money out of them and they're taxable, they're going to be taxed as income, okay, as income. So what are some investments, what are some areas that we can invest our money pre-tax? What's one of the most common ones?
401k.
401k, right? You put the money in the 401k pre-tax, it grows tax deferred, and then when we're ready to retire and we pull the money out, then that's when we finally pay the taxes on it, right? So we'll pay any taxes today, any taxes during the growth, but when do we pay the taxes on this?
We take it
When
out.
we decide to take that money out. So let's go through a couple of those. There's a 401k is the big one. Now what goes along with the 401k, a lot of nurses, teachers, they have what's called what?
403b.
Jim, come on, right? The 403b. He just met with a nurse, she had a 403b. Now if you meet with like a state employee, they have what's called what? It's called a 457c. Basically, they're all the same. They all do the same thing, it's just different names. Another way you can invest your money is in what's called an IRA. But what kind of IRA? We're going to be talking about a traditional IRA. A traditional IRA works the same way as a 401k, okay? There's also what's called a SEP. That's called a Simplified Employee Pension. There's also simple plans as well for small business owners. Here we're 1099, so we actually can set up a simplified employee pension, and we're allowed to put money in that tax deferred. So it'll lower our taxable income for this year. It'll grow tax deferred, and then eventually when we pull out, it'll be taxable. So we're good on that, right?
Mm-hmm.
Now the next area we can invest money is after-tax dollars. So what would be considered after-tax dollars? Well, this means that we got our pay, the government took their taxes out, right? And then this is the money that went into our checking account typically. Where's people usually get their paycheck put into?
Shotgun.
Right into their checking account. Now when the money that we get after tax, we can take that money and invest it as well, right? What are some areas that we can invest our after-tax money that we're gonna put it into an investment, okay, after tax, and then we're gonna be what's called partially taxed on this, okay? So what I mean by this when I say partially taxed is we're gonna be taxed on any interest or any gains that occur on these investments. So you made, I don't know, a couple $1,000, they took your taxes out, and now this is your money. You can invest this money. What are some things that we can invest our money into? This is money that's in your checking account right now. You can go, you got it. Stock market will be one of the first things you can think of. So you can go right now, you could open an E-Trade account online and start trading stocks. Okay, you're not gonna be taxed on the money that you put in there. Why? Because you already pay taxes on it, right? But you are gonna be taxed on what? On any gains that you get from this, any gains that you get, right? So if you buy a stock at 100 and you sell it at 150, right? That sell gained you what? You just made 50. You're gonna pay taxes on that $50 gain. Does that make sense? Now, the way you get taxed on gains is two ways. You get taxed as a short-term gain and a long-term gain, okay? Short-term taxes and long-term capital taxes. What they did, I believe it still is the same, is if you have what's called a long-term capital gain, they're gonna tax you at a flat rate, Okay, okay. Now if you have a short-term capital gain, what they're gonna do, they're gonna tax you as income. So whatever your income tax bracket is, you're gonna pay taxes on that. That's just a little side note. It's not really important to know here. What are some other ways we can invest our money?
Bonds.
Bonds. We could go buy a bond. We could buy a mutual fund. You can put your money into a CD at the bank, and if you earn 5% on that CD, then you're gonna pay taxes on that 5% gain. Do you know right now the money in your savings account typically earns like 0.05% interest or something? At the end of the year, you have to pay taxes on that interest that you gain in those accounts as well.
So that's why it never moves, basically.
Does that make sense, guys?
Mhm.
Right? So this is money that you put in after tax, and then when you decide to take it out or cash in, you're gonna be partially taxed on what? Any
Yes.
gains or interest, you got it? Now, the third way we can invest money, again, is we can take after-tax dollars and take these after-tax dollars and put them into an investment. And now, when we take the money out of here, though, it's gonna be what we call tax-free. So this is actually money that we paid taxes on today, put it into an investment, and then later on down the line, when we take that money out, it's tax-free, because we paid today instead of the opposite. So what are some investments that we could put after-tax dollars in that is gonna grow tax-deferred, and then we'll be able to pull it out tax-free?
Life insurance.
You got it. I heard both of those actually. The first one that would come to mind is the Roth IRA. The Roth IRA works the opposite of a traditional IRA. Traditional says, you want to know what? I don't want to pay taxes today. Let's just invest that, and then I'll pay taxes on it later. The Roth IRA is the opposite. The Roth IRA says, you know what? I'll pay taxes on that money today, and then I'll never have to worry about paying taxes on that money ever again, right? So it's kind of a fine balance. You know, if you're in a lower tax bracket today, then it might make sense to pay the taxes on that. Now, while you're in a low tax bracket, put that money into a Roth, and then later on down the line, you don't have to worry about taxes in the future. Let me ask you a question. If you had to bet, do you think taxes are going to go up or down in the future? What do you think?
We'll have to go up.
Most people would say they're probably going to go up. So if you're thinking that taxes are going to go up in the future, then where do you think it would be smart to have money? In a taxable area or in a non-taxable area? In a non-taxable area. So a lot of people, what they would rather do is pay taxes today, let it grow, and then never have to worry about paying taxes later. Now, there's also an advantage, though, to the traditional IRA, which says the opposite. I'd rather, not pay taxes today. So you might be in a high tax bracket and try to not pay taxes today, and then later on down the line, you'll pull it out and be taxable. So in the after-tax area, you can invest money, and it'll go and grow. It's after-tax money, it goes in, and it grows tax-free. And then we pull it out and it's tax-free. That's a Roth IRA, okay? Another way you can do this is what's called a municipal bond, okay? Call them like a muni. A municipal bond is triple tax exempt. So that means that we pay no taxes on this. So you can take the money in your checking account right now. You already pay taxes on this money. This is after-tax money. You could go buy a municipal bond, and when that thing grows, it's going to grow completely tax-free. It's triple tax exempt, which means that you don't pay any federal, any state, or any local taxes on that, okay? And then the third way is through what's called cash value life insurance, okay? Any cash value that builds in a life insurance policy, you can actually borrow against that and pull that money out tax-free as well. So you take your paycheck, you put your money into it after tax, and then later on down the line, you can pull your money back out tax-free. Now here's the question, okay? When you're looking at these three areas to diversify yourself from a tax standpoint, where do you think most people have the bulk of their retirement assets at? Over here.
Pre-tax.
And this is also pensions. Pensions would fall in there. Annuities would fall into that category, right? So the majority of people's retirement accounts in America right now are all in the pre-tax area, right? How much is over here? This is after-tax money. How many people do you think have a side investment account? Like a little stock account or a couple mutual funds here, or stocks, bonds, a couple CDs at the bank. They might have a little bit here and there,
Jackson probably.
but a little bit, we're seeing, right? Typically. Now, when it comes up here, most people have nothing. Most people have nothing. So the concern with this is, let's say you wanted to retire, and you want to retire with $100,000 a year in retirement. How much money are you going to have to pull out of your portfolio in order to live off $100,000? Probably going to have to pull out about $130,000 out of your portfolio in order to live off of 100, because we're going to have to pay $30,000
Taxes.
a year in what?
Taxes.
In taxes. Taxes. So if we can make our triangle be a little bit more balanced and diversified, to where we have money here, we have some here, but we also have some from a tax-free area. Now what that's going to allow us to do is have more control with our taxes now and in retirement, most importantly. Because most people in retirement are stuck. If they want to pull money out and live off of their money, and they want to pull it out of their retirement account, all their money's where? All in the tax. So they're stuck. They have to pay taxes, and if government decides they're going to raise taxes, then guess what? They're going to have to do one of two things. They're going to have to pull more money out of their 401k than they really planned on, or they're going to have to decide they want to live off a lower retirement lifestyle, right? So there's not really control. You're sort of at the mercy of whatever the government decides to do. So if we can make it a little bit more balanced, never say it's going to be perfect, but if we can have some here, and have some in a tax-free area, now that allows us to be more diversified. Because over here, when we're pulling this $130,000, where's it all coming from? Here, right? Now let's say we need to live off of $100,000, okay? But you can maybe pull $115,000 a year instead of 130. So you're going to pull 115 to live off 100, and you're still going to pay how much in taxes? 15K in taxes. Okay, 15K in taxes. How's this work? Well, we're looking at 115,000 that we need to pull out, right? What if we're able to pull 30 from here? What if we're able to pull 15 from here, and now we're able to pull, what would this be, 70? Is that correct? 70K from this area, okay? Think about it now. This guy over here is pulling 130,000 all from these two areas. You know, if we keep it the same, let's say he keeps the same 15,000 that he pulls from here, that means he's going to be pulling 115,000 all from a taxable area. So this person over here, number one, how much, what is going to be their taxable income for the year for this person over here?
130,000.
They're going to pay taxes on 115,000 of income, and then another on these investments, which is tax. It's going to be taxed differently as gains and stuff, and interest. So, but their income for the year is 115,000. So guess what tax bracket they're going to be in? They're going to be in the $115,000 tax bracket. So they'll be in a higher tax bracket, paying on a higher amount of money, right? So if we're able to diversify ourselves a little bit more from a tax standpoint and be proactive and plan ahead, because most people don't plan to fail like this. The problem is they fail to plan, right? So if we're able to be a little bit more proactive, then what we're going to be able to do is now we're still going to have to pull 70,000 from here, 15 from here, and 30 from here. But what is going to be their taxable income? 70,000. So now on his taxes, he's going to pay taxes on 70,000 versus 115,000.
Lower tax bracket.
He's going to be in a lower tax bracket, right? And he's going to be paying on a lower amount. I don't know the percentages, but let's just say, would you rather pay, I don't know, 33% on 115,000, or would you rather pay, I don't know, 20% on 70,000? That's a big difference in the tax liability that you're going to have. And what it's going to do is going to give you control. Because now, if taxes go up and you have this diversification, then guess what you can do? You can say, you want to know what? I'm just gonna pull more from my tax-free side and less from the taxable side. If taxes decide to go lower in retirement, then you could say, you wanna know what? I can let my tax-free side grow a little bit, and I'll pull a little bit more from my taxable side. But at this time, we're not at the mercy of the government. We're able to have more control over our investments. Now, everybody does this, and everybody does this. But what most people aren't educated on is the tax-free side. Nobody's really aware of how, number one, a Roth IRA works. The problem with a Roth IRA, well, the good thing about it is it works very, very well. I have one myself. But the problem is that you're only allowed to contribute a certain amount per year, and that's it. It's like $5,000 a year right now still, maybe went up to $6,000, I don't know.
It's 5. I just put it into mine.
Okay, perfect, still 5. It's still 5. It hasn't gone up in probably 8 years. They haven't adjusted that yet. Why do they put a cap on that?
Because it's tax free.
Yeah, the government, I mean, they're allowing you a little bit, but they're not gonna let everybody just, run amok with it and just put everything into it, right? So they limit you on that. They do the same thing with a traditional, same thing with everything. They're all limited and capped to some extent, But one thing that a lot of people aren't really educated on, really, is the cash value in the life insurance. See, most members and most people that we meet with, they have a high need for life insurance, and they don't have that need covered at all. And they also have a high need for tax-free income in retirement, and they don't have that area covered at all. So what I find to work very efficient for our members is to have cash value life insurance, because it accomplishes both. It takes care of the life insurance that they need, and it takes care of the tax-free investment that they need in the future as well. So the people that are educated and some of the more smarter people that I meet with, they take advantage of this, and they try their best they can to make sure that they're not putting all their eggs in one basket. Somebody I met with before asked me, said, how come I don't put another $200 a month into my 403B? I said, because that's just going to keep loading up the area that you're already loaded up into, and we're still going to have nothing in the end here. So I'm not asking anybody to invest more money necessarily. We just want to be a little bit more smarter with how we're breaking that up, right? So the big concern is that most people, they have nothing set aside for this. Now here's the other thing that a lot of people don't think about, is that right now all the baby boomers are all coming to retirement, right? Where do you think all of the baby boomers were told to put all of their retirement money?
401k.
Over here.
Pensions, yeah.
Okay? Do you think the government knows statistics on this?
Yes.
Do you know that the baby boomers were a big wave of people? There's a lot, that's a big population that has all this money in these traditional retirement accounts, and they're all about to start pulling it out. Because you guys know what happens at 72 and a half, right? I think it's 72 and a half. It might be 72. What happens to your 401k or IRA at 72? They start making you take what's called mandatory distributions from your 401ks. You have to start taking money out of them. So the government knows that, hey, you might have this money in there, but you're going to have to start taking it out sometime. There's millions and billions of dollars probably in this. So if the government knows that everybody has their money in a fully taxable area, and they all are going to be forced to be taking it out at some point, what do you think the government is thinking? If I raise taxes just a little bit, look how much more that's going to generate for us on our $1 trillion deficit that we're trying to get paid off, right? Who do you think is going to pay that $1 trillion deficit off? The people. We're going to have to, So, so that was something that was huge for me, and it's going to take you a couple times to really think about this and talk about this and learn about this to really get it. You know what I mean? I wouldn't recommend to go over this like with a client tomorrow. You know what I mean? You probably wouldn't get it right. So, it takes a few times, and I probably messed up a few things because I haven't spoke about this in a long time. But, I sat down with a teacher one time, and the teacher was completely covered, had a great coverage, and I said, what can I do for her to help her out? I said, you want to know what? She probably has nothing in a tax-free area. And I said, you know what? You seem smart. You got everything taken care of. You seem very smart. You're probably going to understand this. Let me explain to you this. And I explained to her everything that I just went over, just like this, And I said, so what I'd recommend to do for you will be to try to find a way to get more into a tax-free area. So I don't know if you're currently doing investing right now on a monthly basis, and if it's all going into this area, I would try and find a way to get some of that monthly investing into something that's gonna generate tax-free, right? And she said, what do you think I should do? I said, you definitely should look at a Roth IRA, but you also should look at trying to find ways to get more money into your cash value of your life insurance. Because that's gonna be something that's guaranteed, and it's gonna take care of two needs for you as well. You know, if you're not here, let's say you never make it to retirement, right? Well, then you're at least gonna have some tax-free money to go to your family that way as well. Because if you pass away, where's the 401k money going? It's gonna go to the family, but that's gonna be taxable a lot more than a life insurance policy. Because when people pass away, if you have a $100,000 life insurance policy and you pass away, guess what your family gets? They get $100,000 completely tax-free. They don't have to go through all kind of, different, I guess you would call this estate planning and I guess they would call it, there's some sort of taxes that they have when you pass on money from, generation to generation, especially when it's tied up in retirement accounts. So that's the tax control trial. You guys got it? Is that helpful?
Yeah, definitely.
All right,
Definitely,
awesome,
bro.
awesome,
Thank
cool.
you.
All
Appreciate
right, glad
you.
we knocked that out.
That's fine.
I haven't done this in a while.